Gobbledygook and the implosion of the financial system. Hi there, crypto fans. Dick Allgire here in beautiful Honolulu, Hawaii. Why is it so beautiful today? Because, yay, the trade winds are back. The trade winds are Hawaii's natural air conditioning system. And sometimes September through part of October, the trade winds shut down and it gets really hot and humid. But they're back today, so it's really beautiful. In honor of that, let's put the Ala Moana wave shot up. There we go. Beautiful surf shot from Magic Island. All right, gobbledygook and the implosion of the financial system. You know what gobbledygook is? Let's put up the official definition. Gobbledygook, language that is meaningless or made unintelligible by excessive use of abstruse technical terms, nonsense. I bring this up because the masters of gobbledygook are the financial wizards at the Federal Reserve. The private bankers that make money out of thin air and charge us to use it, they are very good at talking nonsense. Like they just make up these terms, and it sounds so official. I'm going to read about a 2-page article from a financial publication. I could have never been a financial reporter because one of my skills as a reporter was to take technical terms and obtuse language and put it in everyday, understandable language. And I wouldn't have lasted very long as a financial reporter because I would have said, wait, they're just saying that it's a shell game made of nothing. We need a siren going by. Yeah, I always have a siren. Okay, so here's the headline. U.S. Treasury asks major banks if it should buy back bonds. The Treasury is saying to the banks, hey, guys, we know you're having trouble having enough fake money backed by nothing. Can we help you out? We'll buy the bonds back from you. What's a Treasury bond? A Treasury bond is an official-looking piece of paper with some ornate script on it and large denominations that is just basically nothing backed by nuclear weapons. And what we have happening is the U.S. government prints these Treasury bonds and then sells them to banks. But the banks, the private banks, make money out of nothing. They make fake money. There's nothing to back it up. And then they buy the bonds to finance the government. So it's this little shell game happening between the banking system. Traditionally, other countries have bought our bonds. Saudi Arabia, we buy oil from them in dollars, and then they turn around and send the dollars back to us to buy our worthless treasuries, and we keep them secure to pump more oil. China has always bought a lot of our bonds. They're holding over $1 trillion right now. The way that works is they make cheap products with slave labor, sell the products to us, we give them the dollars, and then they pump the dollars back into the Treasury bonds. It is a symbiotic worldwide shell game that's been going on for a long time. The problem is nobody really wants treasuries anymore because they're really not worth anything. It's coming to an end. It's like the musical chairs, the music stopping and somebody needs a place to sit. So the U.S. Treasury is saying, hey, we'll just print these things, then we'll buy them. And here's how they put it in the financial written press. Okay, I'm going to read this. And keep in mind, we're looking for gobbledygook. Terms like decline in liquidity. This is another good one. Supplementary leverage ratios. When we hear that one, I'll explain what it is. Okay, I'm going to read this in my best newscaster voice about the U.S. Treasury buying back bonds. The Treasury is acknowledging the decline in liquidity, and they're hearing what the street has been saying, said Calvin Norris, portfolio manager and U.S. rate strategist at Aegon Asset Management. I think they're investigating whether some of these measures could help improve the situation. He said, buying back-of-the-run treasuries could potentially increase liquidity of outstanding issues, and buyback mechanisms could help contain price swings for treasury bills, which are short-term securities. So, increased liquidity. Increasing liquidity means printing money on a computer out of nothing. So they need to print some more new fake money to buy back the fake treasury bonds. The article continues. However, when it comes to longer-dated government bonds, investors have noted that a major constraint for liquidity is the result of a rule introduced by the Federal Reserve following the 2008 financial crisis, which requires dealers to hold capital against treasuries, limiting their ability to take on risk, particularly at times of high volatility. The underlying cause of the lack of liquidity is that banks, due to their supplementary leverage ratios being capped, don't have the ability to take on more treasuries. I view that as the most significant issue right now, said Norris. So he thinks the biggest issue is after the whole financial system imploded and they reanimated the dead corpse in 2008, they said, maybe we better not just have a complete 100% of fake money buying the treasuries. We should have, what did they call it? A supplementary leverage ratio. The supplementary leverage ratio is this. You've got to have 5% real fake money to buy the real fake treasury bonds. So if you're a bank and you have $5 million, you can use that to buy $100 million worth of treasuries. And the debt is now up into the trillions and trillions and trillions. Okay, back to the article. The Fed in April 2020 temporarily excluded treasuries and central bank deposits from the supplementary leverage ratio, a capital adequacy measure, as an excess of bank deposits and treasury bonds raised bank capital requirements on what are viewed as safe assets. But it let that exclusion expire, and big banks had to resume holding an extra layer of loss-absorbing capital against treasuries and central bank deposits. So in 2020, they said, hey, you can't just have 100% fake money buying treasuries. You've got to have 5%. And now they're saying, oh, man, they can't even come up with 5%. We've got to exclude that asset ratio, supplementary asset ratio. So that's what they're saying there. The Treasury Borrowing Advisory Committee, a group of banks and investors that advise the government on its funding, has said that Treasury buybacks could enhance market liquidity and dampen swings in Treasury bill issuance and cash balances. Gobbledygook, just fancy sounding terms, which means this game is coming to an end. When is it going to end? A lot of us thought it was going to end before this. It was due to end in 2008, but they started buying their own debt, and now they want to keep buying their own debt. How long can they do that? I don't know. Could this foreseeably go on for the rest of my lifetime? When it does fail, it's going to fail spectacularly. You're going to see people going, my pension is, but my pension, my Social Security is, what about my Social Security? My 401k is, but what happened to that? The money in the bank, it's what? And we will see cryptos rise from the ashes. Is it going to happen soon? God, I hope so.